Hello everyone, how are you all doing? So this is a taxation session which is applicable for CA and CMA. Last class we have learned who is taxing, who is the authority to tax. Of course it is government. Government is authorized, or government is empowered by Constitution of India to collect tax from the assessees or individual, all the individuals in the sense that all the assessees. So government is authorized to collect tax from public. Government is empowered by the Constitution of India. Government is taxing for running the country and developing the country. In order to run a country, a government is always required power, money. Power is given by the Constitution of India, and money is raising by doing business by a government. We know that railways, many corporations, they are doing business and they're collecting tax. We saw in the last class, taxes, there are two kind of tax: direct tax, indirect tax. And under direct tax, income tax is coming, which is a major section. And we have in these coming sessions, we will be covering the income tax. This section is applicable for CA and CMAs for September 26 exam window for intermediate, and for, of course, naturally for working professionals. Income tax is a core subject now because everybody is connected with the income tax, or one or other way. We are all liable to pay tax based on the income we are generating. So the last class we also covered that income tax is charged on the total income of an assessee or a person. So in these sessions we will be coming, or we are going through in details, which is a core areas, and now onward the exam important areas are covering also. We are entering into a first chapter. So we understood that income tax is charged on the total income of a person earned during the previous year, which is taxed in the assessment year. So total income, previous year, assessment year, aggregate total income, tax rate, and arriving the tax. So this is the areas we covered in the last class. So those who are not covered in the last class, please go through the CA-CMA class, taxation class 1, which we will be giving a major idea of that. That is a base for that. And now onwards, this is a core area. Please don't miss it and watch it carefully. Also, those who are not subscribed, please subscribe the channel and watch and comment on that. So those who are not watched the video first class, please go to that first particular class number 1 and watch it before coming into this class, because that is the base class, and all these classes are now in continuity. So we are going by steps. So if you are not gone through a particular class or missed a class, then the continuity may be missing that. So you may not be able to understand for that. So please watch the video number 1, CA-CMA taxation class 1, and come and see the this section, which is class number 2. In these sessions, we will be able to cover who is the person and what is assessment year, what is the previous year, what is the total income on that, etc. These are all the major areas, and these areas basically coming under is very important for the exam also. In these beginning sessions, in this class is very important because this area is mostly giving weightage in the income tax exam for CA as well as CMA. So please watch, please comment on that, and those who missed to watch the video number 1, please go and watch and come and see the second video and continue for that. Those who are not subscribed the video, please subscribe and put your comment. All comments are always welcome. So if you have any suggestions, if you have any queries on that, if you have any doubt on that, please put your doubts or comment or whatever in the comment sections, which definitely I will go through this and I will come back. Okay, so let's continue. In the last class, we understood that government is imposing tax based on the powers given by the Constitution of India. Government is collecting money to run the country, developing the country, and government is collecting money by doing business and collecting. Government is raising money by doing business and collecting tax. There are direct tax and indirect tax. So now, and also we understood that there are various taxes, different types of taxes, which is direct tax as well as indirect tax. And this major section in this section is for direct tax. And also we understood that there are different kind of persons which is liable to pay taxes, and who needs to pay tax. So in detail, the assessee, who is the person who is assessee, and that's coming in these sections. Basically, this is coming in these sections. So before that, what is important is that where the income is chargeable. For example, I'm an Indian citizen, I'm an Indian national working abroad, for example, working in Dubai or in USA. That income is taxable in India? No, it is not taxable in India. So the condition is income tax is applicable to income generated in India, which is important to know, that income to be generated in India. Normally, a person generating income is taxable in India. So that means the condition is that income to be generated in India. There are two exceptional cases wherein, for example, a person doing shipping business or doing any other activities in the ocean or sea, wherein government is declared that such a person is raising money or income which is in 12 nautical miles is also taxable. And a person raising money is in Indian within the ocean limit of 12 nautical miles is also taxable in India. Certain other case, government is also declared that 200 nautical miles also taxable in exceptional cases with a very different contexts and situations. So now it is important to know that a person raising or generating income within India is taxable in India. Other cases, exceptional cases, and which is notified by government, 12 nautical miles within the ocean limit, anybody is generating income is also taxable in India. Next is Income Tax Act. We know that income tax calculation is everything based on the Income Tax Act 1961. But at the same time, which is an act passed in 1961, but at the same time, income tax is calculating or based on the Finance Act, and each Finance Act, the rate is fixed for that. So Income Tax Act 1961 and the supporting income tax rules 1961 is the base governing or the law in which we are taking as the base for calculating income. So Income Tax Act 1961 and Income Tax Act 1962 rules, Income Tax Act 1961 and Income Tax rules 1962 are the base for governing in the tax process. Basically, we can say the tax, imposing tax, calculating tax, assessment, all the procedures taking care. So, but at the same time, Income Tax Act is 1961 and Income Tax Rules 1962, which is constant basically. At the same time, we know that tax is calculating based on the Finance Act. So, Income Tax Act changes happening in every year. Income Tax Act changes happening every year based on the budget section and the Finance Act. We know that 1st February every year there is a finance bill, and based on that, finance minister is now last 10 years, last 2 sessions basically. Nirmala Sitharamanji was the finance minister, or is the finance minister, wherein he is submitting the budgets, proposing the budget, and both the House of Parliament is discussing, and finance upon approval or upon agreement by both the parliaments, I mean Rajya Sabha and Lok Sabha, is submitting to the Honorable President of India. And the President of India can seek clarification as well, and if there is if things are fine with that, the President of India is approving or signing with that. That means signing is the process in which that become Finance Act. So Finance Act is changing every year. As far as 2024-25 is the previous year in which the tax is applicable for the September 26 exam, in which the tax rate is also applicable for from 1st April 2024 assessment year. That is the base for calculating for that. On that basis, we are discussing about the Finance Act. So upon signing and approving both the House of Parliament, Finance Act is forming. Upon approving Finance Act, upon approving the draft financial bill, President of India, once it is approved, that means both the House of Finance Minister is submitting in the finance draft, and both the House of Parliament is discussing and approving, and so once both the House are approved, it is going into President of India, and President of India is signing on that. Once President of India sign, it's become the Act. So if you see that, latest on as far as this particular session is applicable, 1st February 2025, Finance Minister Nirmala Sitharamanji proposed the budget in both the House of Parliament. There are so many discussions are happening, and end of the day, end of the sessions, government is approving based on the majority, we know that, and both the House of Parliaments agreed the budget, and this budget is going to President of India. President of India signing the budget or approving the budget. His signature is the approval process, and we know that is the Finance Act or Income Tax Act 1925 is enacted. So now the question is, how many Finance Act can happen in a year? Because in a budget meeting normally happening in a year, so it's an important question. So how many Finance Act can happen in a year? Normally in a general case, only one Finance Act can happen in a year based on the, 1st February concerned finance minister submitting the budget, and both the House of Parliament is discussing and approving the budget. That is the one-time process, and there is only one Finance Act is happening. But there are certain cases wherein there is an election happening for central government. Normally for electing the central government, it's such cases there can be more than one, which is two Finance Act. So wherever there is an election happening in a year, it can be two Finance Act. Because 1st of February, we know that it is a session's budget to be submitted, which is generally called interim budget. For example, the particular tenure of the parliament or the ministry is completing, but that year also the budget is to be submitted irrespective of whether they are outgoing or they are continuing for that. So 1st February the budget is proposing and the discussion is happening, and that become a finance act for that. But after that the election is happening, February, March or April, something is the budget is happening, and the new government is also forming for that. Such cases, the new government, there is one more section is happening, Interim Finance Act. Again, they're discussing for that, and the final Finance Act is, which is called Finance Act, final post-election. After the election, government is declaring the Finance Act. Final Finance Act is happening. So there can be two, normally in any situations, only one Finance Act, but where there is an election is happening in that year, there can be two Finance Act. So the process, this is the note is important to note that how become a Finance Act. So in each year, first February, the Finance Minister, for example, now Nirmala Sitharaman ji submitted the budget, and the same is discussed in both the House of Parliament. Upon completing or upon approval from both the House of Parliament, it's going to President, and President is signing the budget, and upon signing the budget, this become Finance Act for that particular year. I'm mentioning this Finance Act 2025 means 1st February the Finance Minister submitted the budget. Both the House of Parliament, Rajya Sabha and Lok Sabha is Lok Sabha and Rajya Sabha discussed and approved the budget. And upon completion of approval from both the houses, it's going to the President of India, and President of India is signing the budget. That becomes the Finance Act 2025. So that means Finance Bill 2025 become a Finance Act when the President of India signing the bill. So Finance Bill approved by both the House of Parliament is going to President of India for signature, and once the President of India signed the budget, it become Finance Act. So as we in the last class again we discussed that there are Finance Act, Finance Rules. Finance Rules is a broader term which includes the Finance Act, then circulars, notifications, etc., clarifications, etc. will come. That's all together in the Finance Rules. So what do you mean notifications? This can be a short answer questions. Notifications are basically issued by the central government, or sometimes it can be Central Board of Direct Taxes, to given the amendment of certain Finance Act. So Finance Act is happening in certain cases wherein some amendments or some clarifications is required, and in such cases government is issuing a notifications. In that case, either it is a central government or a Central Board of Direct Tax is giving an amendment for such a passing the act. To already the budget is passed and it become Finance Act on that. After that, there will be certain notifications will be issued, and the notifications can be central government or it can be Central Board of Direct Tax can be issued on that. So example, this amendment is effected in 1st April 2025. Notification is bound by the department as well as assessee. It is so important that there is a difference between notification and circulars. So notification is normally happening from Government of India or by Central Board of Direct Taxes. In order to make the effect to the Finance Act, and that circular is to be bound by government as well as assessee. Both the parties are bound to follow the notification. But in certain cases, there is circulars on that. These are circulars issued by Central Board of Direct Taxes. Basically, Central Board of Direct Taxes is issuing the circulars. Maybe certain additional provisions, so there are certain clarifications for that. It is to be bound by the government only. So it's not to be bound by the assessees. So circulars. So Income Tax Act circulars. Circulars as well as notifications altogether become the income tax rules for that. Next is an important section, which is last class we have a brief on that, which is section 4 of Income Tax Act, which is a charging section. As briefly we discussed that income tax is charged on the total income of a person or an assessee. Income tax is charged on the total income of a person or an assessee. We will be coming in the section that who is person and assessee. So income tax is charged on the total income of the person, and income tax is charged in the total income of the person and income of all the total income of all the assessment year. Have you identified the difference for that? Income tax is charged on the total income of all the assessment year. So that means there are different kinds of incomes which we will be discussing for that. So it is important to know at this point, it is very important. This charging section is very important from the examination point of view. Income tax is charged on the total income of the assessment year. For an assessee, it is needless to say that income tax is charged on the total income of the assessee of the assessment year. Income tax is charged on every person under section 231. Income tax is based on the total income of the person during the assessment year, which is normally happening in the previous year, and it is taxed in the assessment year. That is the difference, assessment year and previous year, which will be coming in the next section. So income tax is charged on the total income of the assessee for the assessment year, and income tax is charged on every person under section 31. So who is the person which is again is coming in the sections. Next is income tax is charged on the assessment year based on the income during the previous year. So income is based on the total income during the assessment year. Based on the income, based on the assessment year means that income is taxed in the assessment year, but income is taxed based on the income earned during the previous year. So income is taxed on the total income of the assessee for the assessment year. Income is charged on every person under section 21. Income is charged on based on the total income of earned during the previous year, and income tax is fixed as per the Finance Act of every year. Repeat, we will recollect one more. It's an important question point of view. Income tax is charged on the total income of a person during the assessment year. Income tax is taxed on all the persons as per section 231. Income tax is, the rate is fixed by each Finance Act, and the next is income tax is fixed by Finance Act, each Finance Act, and important is that income to be deducted at source or tax to be paid in advance. So these 5 points are very important in case of a charging sections. Repeat it. Income tax is charged on the total income of a person. Income tax is charged on all the persons as per section 231. Income tax is charged on the total income earned during the previous year, which is taxed in the assessment year. Income tax rate is following as per the Finance Act of each year, and income to be deducted or paid in advance. Incomes to be deducted or to be paid in advance. 5 point only. I will repeat once again. Income is charged on the total income of a person. Income is to be collected, in all the income raised by a person under section 231 is taxable. All the taxes based on the income earned during the previous year. Tax is based on the tax rate fixed by the Finance Act, and income tax to be paid in either TDS to be deducted and paid, or advance in tax as advance tax to be paid. Total income of the persons to be paid. Income tax is collected on the basis of all the assessees based on the residential status, which will be coming for that. And tax is based on the rate fixed by the Finance Act, and income tax is to be paid in advance. I'll repeat it. Income tax is charged on the total income of a person. Income tax is collected and in tax to be paid for all the persons under 2 section subsection 31. Income tax rate is fixed in the Finance Act, and tax is charged on the income earned during the previous year, and income tax to be paid in either tax deducted at source where the income is generating, or the tax is to be paid in advance. This is an important point to be remembered. Next is assessment year and previous year. So assessment year is a 12 months period commencing from 1st April to 31st March in India. Because if you are looking into Dubai or if you are looking into USA, the financial year is a 12 months calendar year, which is January to December. But as far as India is concerned, assessment year is a 12 months periods commencing from 1st April and ending with the 31st March every year. And income earned by an assessee during the previous year is taxable in the assessment year, which tax is applicable as per the Finance Act. So last we discussed that income earned by a person during the previous year is taxed in the assessment year. So assessment year is in simple terms 12 months periods commencing from 1st April to 31st of March. Income earned by an assessee during the previous year is taxed in the assessment year at the rate in which the tax is applicable. For example, 1st April 2025 to 31st March of 2026 is the previous year. In that case, assessment year will be falling on 26-27. So when you are approaching for exam, when you are giving the exam, your assessment year will be 26-27, and for the previous year will be 25-26. So it should not be confused. When your exam September 26, the assessment year will be 26-27, and the previous year will be 25-26. So in this case, to identify the clearly assessment year and previous year, assessment year is a 12 months periods commencing from 1st April to 31st March period. Income earned by the person during the previous year is taxable in the assessment year. For example, income earned by a person from 1st April 2025 to 31st March 2026 is taxable in the year 2026-27 assessment year. So if you know the assessment year, it is it's easy to understand the previous year. So previous year income is taxable in the assessment year, but again should not be misunderstood. Income to be paid in advance or TDS to be paid. So income earned during 2024, that means 1st April 2024 to 31st March 2026 needs to be assessed in 2026-27, but tax to be paid it in advance or TDS to be deducted. That means in case of an employee, salary, based on the salary that they're arriving the total income, and based on that the tax amount will be deducted and paid to the government. For the concerned employee, based on the total income arrival on 26-27, he can submit the return, and in case of he is eligible for refund, he can get the refund. So it is important to know that assessment year is the 12 months period starting from 1st April to 31st March of every year. Income earned during the previous year is taxed in the assessment year. And example, in case of 1st April 2025 to 31st March of 26 is the previous year for 26-27 assessment year. So all those income earned by a person during the previous year is taxed in the assessment year. Normally previous year is starting from 1st April and end on 31st March. So you will feel that what is the difference between, as I mentioned to you, assessment year is the 12 months calendar period which is starting from 1st April to 31st of March. In both the cases, it is starting from 1st April to 31st of March, but assessment year is a 12 months period starting from 1st April to 31st March, wherein income earned during the previous year is taxable in the assessment year. In as far as previous year is concerned, previous year is 12 months periods. Previous year is a 12 months, same 12 months previous period, but income earned during the previous year is taxable in the assessment year. So to identify the difference previous year and assessment year, for the running current year, 1st April 2025 to 31st March 2026 is the previous year for assessment year, 1st April 2026 to 27. Hope it is very clear. Both assessment year and previous year are 12 months starting from that. Income earned during the previous year is taxed in the assessment year. So next is very important in terms of exam point of view. Person. Income Tax Act 2 subsection 31 clearly define a person, because in every time we will say that a person is liable to pay tax. A person liable to pay is called assessee. Same way. So who is the person? As per Income Tax Act, person is an income tax charged on total income of a previous year. We discussed that income tax is charged on the total income of a person earned during the previous year is taxed in the assessment year. So who is the person for that? Income tax is charged on the total income of a person during the previous year is taxed in the assessment year. So the person includes, Income Tax Act is clearly defined who is the person. A person includes an individual. Individual in the sense that a natural human being, a natural person who may be a male or female or minor, a major, a sane person or insane person, those are all coming under individual. So individual is a natural person. Next is a Hindu undivided family. So nowadays, families are becoming minute stages wherein one or two members, husband and wife and two children, that is the family. But in earlier days, or in maybe in the past 10 years back, when you see that a family may be consisting of grandparents, then grandparents, then husband and wife, then couple of children, that's all together become a family, mostly happening in Hindu family, which is called Hindu undivided family. Altogether it is a family. So individual includes a natural person and a Hindu undivided family. And third is, in Hindu undivided family includes all the descendant members, common ancestors, including the wives, unmarried daughters. All together it's coming under Hindu undivided family. So Hindu undivided family means it's all coming under the literally a lineally descendant from common ancestors. It is, they're all in the same under same hierarchy, and they're all part of ancestral, include their wife, husband or wife, and the unmarried daughters. Once it is married means they becoming a different family, so that is not coming under undivided family. So individual persons include section 2 subsection 31 defines individuals include, person includes individual, Hindu undivided family, and third is a company. A company includes, it can be an Indian company or any body corporates incorporated under the law of the company outside India. A company can be an Indian company or a company registered outside India, or an institution associated or body where incorporated or not, whether Indian or a non-Indian, which is declared by general order, special order of board to be a special assessment year. So it is special cases wherein government is declaring as a special resolutions in which a company is to be we declared as, we are as deemed to be a company in India. So a person includes an individual person, a normal person with a human being. Second is a Hindu undivided family. Third is a company. A company can be an Indian company, or any other body corporates incorporated under any law of the country, India or outside India. So company, individual, HUF, company, and third is a firm. Firm means you know that it is a partnership firm. Partnership firm includes LLP firm, limited liability partnerships. Basically, partnerships are limited to the extent of the partnership is not limited, but there are certain partnership firms are limited. So in any case, firm is coming under an individual and an association of person or a body of individuals, whether incorporated or not, or it is registered or not. Any association of person, AOP or BOI, association of person or body of individual, is also coming under person. So let's recap it. A person includes an individual, HUF, company, an association of person, and a firm includes LLP. Repeat it. Individual, HUF, Hindu undivided family, a company, whether it's an Indian company or a company registered outside India, coming under the purview, it's a company, and a firm. Firm means partnership firm and includes a limited liability partnership and an association of person and a body of individuals. So these are the persons category. An association of person means an association of persons is one or more persons joined together for a common purpose. We define the company. Company means an association of persons who contribute to money or money is worth to a common purpose. It is called a stock. So company is an association of person. Company is an association of person who contribute money or money is worth. Money, maybe it can be money or money is worth to a common purpose, to do some business maybe. So same way, an association of person means an association of persons which is two or more persons joined together for a common purpose and to do a common business and generate income, profit, or with a motive to earn profit. So an association of person and body of individuals are the fifth category. So individuals includes person includes an individual. Person includes individual. Individual means a natural person. Second is HUF, a Hindu undivided family. Third is a company, and fourth is a firm. Firm includes limited liability partnership and an association of person of body of individuals. This is showing that an individual, a HUF, a corporate entity or a company basically, and an association of person, a local authority, and a partnership firm. These are the association person. We explained that association person joined together for a purpose. It can be a natural member, or a firm or a body of individual can become an association of person. This is the difference actually. An association of person, so AOP includes person joined for a specific purpose, but anyone can be a member of natural person or a firm or a body of individual, or a natural person or body of individual can be a part of association of person. But a firm, a partnership, LLP registered under Section 4 of the Partnership Act 1932 or LLP Act 2008. So association of person means it can be a natural person or it can be a body of individuals, or a corporate also can be a part of association of person. Next is assessee. This is very important sections. Charging section as per Section 4, same way. This is a section assessee. Who is assessee? In general case, actually, every taxpayer is an assessee. There are different kinds of assessees basically. We saw that who is an assessee. This is a section 2 subsection 7 is saying that assessee there can be different kinds of assessee. In general parlance or general sense, we can say that taxpayer is an assessee. Or some procedures happen, but still there is a procedure is still pending, or the process is still pending, or some default cases wherein a person is undergoing a tax procedures is all coming under assessee. So let's see that what is an assessee. Assessee general sense, actually taxpayer is an assessee, but this is a definition sections. I mean, from the exam point of view, this is a definition area. An assessee means a person by whom any tax or any other sum of money payable under this act. So this is a definition. Section 2, subsection 7 of the Income Tax Act defines an assessee as any person by whom any tax or any other sum of money payable under this act. Repeat it. Any section 2, subsection 7 of the Income Tax Act define assessee means any person by whom any tax or any other sum of money payable under this act. It can be an interest, or it can be a default payment, or it can be declared amount which is pending for payment. So any payment, any amount payable by a person to an income tax department can be an assessee. So it's a definition. Income Tax Act section 2 subsection 7 defines assessee means any person by whom any tax or any sum of money payable under this act. So that means every person by whom any proceedings under this act has been taken for the assessment year income, or any other person in respect of which he is assessable or refund is also an assessee. For example, during the process, there can be, as I mentioned, that there can be some process in which a person is still need to be paid the tax or need to get the refund from income tax, because we are all paying the money. I mean, from our salary, our employer is deducting money and paying to income tax department. And end of the year and or in the assessment year, when we calculating the total income, we finding that there is a refund to us, which is we excess paid for that and we need to get the money. So and that case also an assessee. So generally, assessee means any person by whom any tax or any other sum of money payable under this act. Act means to the government or to get the return. So every person respective by whom any proceedings under this act. This is very important. Any person liable to pay any tax is coming under an assessee. Any person in respect of whom any proceedings under this act is also coming under an assessee. Every person who is deemed to be an assessee under any provisions of this act. So one is any person liable to pay tax under this act. Next is an assessee includes any person by whom any proceedings is still pending is to be treated as an assessee. And next is every person who is deemed to be an assessee. A person is deemed to be an assessee. We will coming in the section that person who is deemed to be an assessee. Every person is deemed to be an assessee in default under this provision of this act is also assumed as assessee. So one is any person by whom any tax or any other sum of money payable under this act, in which a person is in respect of any proceedings under this act. I mean, there are tax procedures going on, and there may be an investigation, verifications, search, seizure all going on. That such cases, it is also called an assessee. Person connected with that process can be an assessee. And every person who is deemed to be an assessee under the provisions of this act. A person proceedings pending cases can be an assessee. At the same time, there can be directly a deemed assessee is also possible. Every person deemed to be an assessee, also every person who is deemed to be an assessee in default. What is the difference? Every person can deemed to be an assessee by deemed method a person can be an assessee, but at the same time every person who is deemed to be a person by default, a deemed person who is in default also can be an assessee. So I will repeat once again. An assessee under section 2 subsection 7 means a person by whom any tax or any other sum of money payable under this Income Tax Act. Any person by whom any tax or any sum of money payable under this act. This includes money payable or money receivable, I mean in the form of refund, is an assessee. Every person in respect of whom any proceedings also coming under this assessee. Any person deemed to be an assessee under any provisions of this act. So any person by whom any tax or any amount of money payable or receivable can be an assessee. Any person by whom any proceedings under this act or any provisions of act can be an assessee. Third is any person who is deemed to be an assessee can be a deemed to be an assessee can be an assessee. And next is a person deemed to be an assessee and default can also be an assessee. So please remember this. So what we discussed in these sessions so far in this assessee's question is person liable to pay tax for the income generated in India. Person who is liable to pay tax for the money generated in India, but there are 12 nautical miles, which is exceptional case, and 200 nautical miles, which is notified by the Finance Act for that. And any person who is liable to pay tax is an assessee. Any person liable to pay or any other sum of money is under this act is deemed to be a assessee. Any person liable to pay is very clearly defined tax, is not a deemed case. Any person liable to pay any amount of tax or any other sum of money is called assessee. Any person respect of any proceedings under this act. So as per Income Tax Act, any procedure or any proceedings pending, such person is treated as an assessee. Every person who is deemed to be an assessee under the provisions of this act. So any person liable to pay any tax or any sum of money, any person in respect of any proceedings pending, such person is treated as an assessee. Any person by whom a deemed person is also to be any person by whom deemed to be an assessee or under this any provisions of this act is also, because there are so many provisions in which a person is liable to pay tax or any provision is pending for that, or any person is deemed to be an assessee under any of these provisions of this act is can be an assessee. And every person who is deemed to be an assessee in default, a person is deemed to be an assessee who is in default, which is already the procedure is happened and deemed by deemed method, and the procedure is not completed and is still pending, or is in default, he did not completed his obligations to pay the tax and it is pending. These are also deemed cases. It is not necessary, an exceptional case, it is not necessary to the pay to person must pay tax on its own income. For example, some cases any minor can be minor's income is forming part of income of the parent. So it is not necessary that the person must pay tax for his own income. Sometimes he is liable to pay tax on the income of others as well. In such cases, he is also to be. So who is deemed assessee? This is what we are saying. So we saw that any tax or any other sum of money payable under this act is an assessee. A person who is in default, a person who is deemed to be an assessee, a person such person who is generated income, not necessarily be the same person. I need to pay the tax out of the earnings from my own only, not necessary. It can be somebody else also. In such cases, if I am paying somebody on behalf of somebody, I myself to be treated as a deemed person. For example, after the death of a person, his legal representative is treated as an assessee for the income of the deceased. For example, my parents had a couple of properties, incomes, and which the process is pending for that. After the death of the parents, the deceased, the legal heirs become the assessee. If the process is started, I am in default for that, and such cases, the default person also become an assessee for that. A person representing a non-resident or minor or lunatic person treated as an assessee in respect of the income. So, let us summarize this one. An assessee under section 2 subsection 7 means a person by whom any tax or any other sum of money payable under this act, payable or receivable. A person who is in income which is deemed to be an assessee under any provisions of this act. Under the provisions of this act, any procedure is pending, such cases can be an assessee. A person is deemed to be an assessee but is in default, is become an assessee. So we'll recollect this one. An assessee means a person by whom any tax or any other sum of money. A person by whom any tax or any other sum of money payable under this act is an assessee. Every person respect to whom any proceedings under this act. So any person liable to pay any tax or under this act, or a person who is procedure is pending for that, a person who is deemed to be an assessee, a person who is deemed person but who is in default also. Deemed person is already a person, and a deemed person who is in default again can also be a person under an assessee. Hope all these sections are very clear. So today's total sections we can recapitulate, in which, so we started income is taxable when the income generated in India. Income taxable when the income generated in India. So exception is 12 nautical miles where in the ocean limit where the government is declared, plus 200 miles nautical miles. In certain cases, government is notified for that. Income Tax Act is 1961 and Income Tax Rules 1962 are the base for calculating income. Income Tax Act is the base Act 1961 and Income Tax Rules 1962 are the continuation to the Income Tax Act 1961, which is the base act for that. But in every year, Finance Act is passing. How the Finance Act is passing is, the Finance Ministry is submitting the bill. Finance Act is submitting the draft, basically. Finance Minister submitting the draft budget. And draft will be discussed in both the House of Parliament, Lok Sabha and Rajya Sabha, on both the House of Parliament. And upon completion and upon agreement agreement by both the House of Parliament, it's going to the President of India, and President of India is signing. In that, upon signing, the President of India, once the bill is signed, become Finance Act for that. For example, 1st February 2025, Finance Minister submitted the draft, and the draft is discussed in the Parliament, both the House of Parliament. And on 1st April, the bill, once the government is approved, it's become a bill, and the bill is going to central bill is after completion of the procedure from both the House of Parliament, it is going to President of India for signature. Once the President is signed, it's become Finance Act for that. This is the process. There can be, normally there will be one Finance Act, but in cases wherein elections are happening, and after the elections there can be another Finance Act. The first Finance Act is called Interim Finance Act, and the subsequent post-election is called Final Finance Act happening. So the process we explained on that, and the next is the notification and circular. Notification is issued by government or Central Board of Direct Tax, which is to justify or to give an effect on the amendment. To give an effect on the amendment is called notification. And notification needs to be followed by an assessee as well as assessor, which is government. And circular is basically issued by the Central Board of Direct Tax, and this to be borne by the government only or department only. Next, we understood that what is a charging section. Charging section is that income is charged on the total income of the person for the assessment year. Income tax is charged on every person under section 231. So income tax is charged on the total income of the person during the previous year is charged in the assessment year. Income tax is charged on every person under section 231. Income tax is charged on the assessment year based on the previous year. Person who raised the income during the previous year is taxed in the assessment year. So income tax is charged on the total income of the person or an assessee in the assessment year. Income tax is charged on every person under section 2 31, section 2 subsection 31. Income tax is charged on every person based on the income earned during the previous year is taxed in the assessment year. And the next is income tax rate is fixed by each Finance Act, and income tax is to be paid in advance or TDS to be applied or tax to be deducted at source. This is charging section 4, which is important. And we saw the assessment year and previous year, which is assessment year and previous year both are 12 months calendar year starting from 1st April to 31st of March. Income earned during the previous year is taxed in the assessment year. As far as assessment year is concerned, 1st April to 31st of March. So how we identify the difference is that income earned during the previous year is taxed in the assessment year. Income earned during the previous year is to be paid in advance or TDS is applicable. Tax deducted at source is applicable. And person is another section which includes person means any person by whom any tax or any other sum of money payable under this act. A person includes an individual, HUF, company, a firm which includes limited liability partnership, and an association of person or body of individual. Association of person means two or more persons joining together to do some business or to some activity and earn profit or earn money. And an association of persons can be a natural person or a company or kind of unnatural person, or an association of body of individuals can be an association of person. This is what we covered on that. And the last one is assessee. Assessee means a person by whom any tax or any other sum of money payable under this act. Any person, the procedure is pending. Every person in respect of by whom any proceedings under this act is also can be treated as an assessee. Every person who is deemed to be an assessee. So any person by whom any tax or any other sum of money clearly payable under this act is an assessee. Any person's pending cases is there, that person can be an assessee. Every person who is deemed to be an assessee under any provisions of this act can be an assessee. And next is every person who is deemed to be an assessee in default can also be an assessee. Repeat it. Any person by whom any tax or any other sum of money payable under this act, any proceedings under this act is pending, is to be treated as an assessee. Any person who is deemed to be an assessee, for example, we discussed that a legal heirs, parents expired and the property and the income is tax is payable to the government, and the legal heir become the deemed assessee. So that is the deemed assessee. And such some deemed assessees cases wherein the procedure is pending, or deemed cases wherein the default, for example, my parents' income is supposed to be paid tax, and now being a legal heir, I am liable to pay tax for that, and it is pending with me, and the process is pending with me. I will be I am a person under default until and unless I am paying the tax to the government. I will be a person assessee under default. Can also be a assessee. So any person by whom any tax or any sum of money, this is an important section. Mostly a question can be expected. An assessee, which is an important section, that's why I'm repeating. An assessee means any person by whom any tax or any sum of money payable under this act. Any person who is in any procedures under this act is to be treated as an assessee. Any persons to be deemed person can be an assessee. A deemed person means a person by legal heirs in case of a deceased person. For example, a minor, a parent's case in case of a minor can be a deemed person, and also a deemed person who is in default. For example, tax is assessed, but a person is still pending for that, or litigation or case is happening for that. SSC in default also can be treated as an SSC. Hope this is understood, and it is very important to note that in these sections you can assessment year previous year is important, and SSC is important, person is important. So these are the major areas. Please make a note on that to please read it properly, and please watch and comment on this. Thank you for watching this. Please subscribe the channel. Always use the continuity, use the flow from video number 1 to that, because it is in the same flow. And as I mentioned that from this class 2 onwards, it is important for exams. So please watch it carefully, and those who are not subscribed, please subscribe the channel, and also please click the subscription also please subscribe along with that, then only you will get the continuity on that. Otherwise you will not be getting all the videos for that. So click on, there is a bell button which you can subscribe. So click the bell button, then whenever I am uploading the videos, you will get to know that uploaded the videos which you can watch and to learn it. I hope this session is understood, and if you have any clarification that, please don't hesitate to comment on that and like the video, and please share it to your known people and those who are studying or those who are in the professional. Thank you.